Shares of C3.ai sinking today after the company posted a deeper full-year loss than expected and pulled back from its original forecast to reach non-GAAP profitability by the end of fiscal 2024. The shares are down by 13%. Tom Siebel's company, which the ticker's literally AI, and it has benefited a lot from AI enthusiasm this year.
Last week was tumultuous for C3.ai. The enterprise AI solutions provider saw its shares plummet by 26% in August, following disappointing quarterly revenue forecasts and the decision to abandon its profitability target. On September 7th, C3.ai released its Q1 results, which showed a 10.1% rise in revenue and a narrower net loss. However, the company also announced that it would invest more in generative AI offerings. This resulted in the share price dropping by 10% on the same day. The stock continued declining on September 8th as analysts doubted the company's growth prospects and valuation. On September 8th, the stock closed at $28.04, 12.4% lower than the closing price of $31.22 on September 1st. Since the peak of $62.70 in February, the stock has lost more than half of its value. Despite this, some analysts still believe in the company's innovative technology and long-term vision. C3.ai is a leader in generative AI, which employs deep learning to produce new content and data from existing data. The company claims that its generative AI technology can help solve complex problems and generate new value across multiple industries. C3.ai has collaborated with major cloud providers such as Microsoft and Amazon and clients including Shell, Baker Hughes, and the U.S. Air Force. C3.ai is expected to face stiff competition from other AI companies, including OpenAI and Hugging Face, as well as software giants such as Salesforce and Oracle. The company must demonstrate its ability to scale its business, retain its customers, and deliver consistent growth and profitability in the future. In this episode, we will discuss the exciting topic of C3.ai stock performance, the potential challenges faced by AI stocks in the near future, and how C3.ai stock is likely to perform despite any obstacles or market pressures. Be sure to watch until the end to gain valuable insights for your AI stock investment journey. C3.ai, with ticker code AI, delivered its fiscal first quarter earnings results on Wednesday after the market closed. The company surpassed expectations on both revenue and earnings, but still posted a loss. I think that the results are not impressive enough to justify a buy rating. The company beat estimates on both revenue and earnings, which is always a positive sign. However, the company still lost money during the quarter. This was not only the case on a GAAP basis, but also on a non-GAAP basis, which excludes one-time items and non-cash expenses such as share-based compensation expenses, which amounted to a hefty $50 million during the quarter. We can, therefore, say that C3.ai is, at least for now, deeply unprofitable. The revenue growth rate was higher than expected, but it was not very impressive in absolute terms, in my opinion. 11% revenue growth for an AI player is not very impressive, especially when we compare it to other AI players such as NVIDIA, which achieved revenue growth of more than 100% over the same period from a much higher base. It seems that C3.ai does not benefit from the AI megatrend as much as NVIDIA and some other AI leaders. Let's examine the numbers in more detail. C3.ai Q1 earnings results. Key highlights: C3.ai's better-than-expected revenue growth brought the company's sales to $72 million for the quarter, which is close to $300 million on an annualized basis. About 85% of these revenues are subscription-based, which is good, as subscription-based revenues are less volatile and more predictable than non-subscription-based revenues. Investors usually prefer subscription-based revenues and often reward companies with a high ratio of subscription-based revenues with higher valuations, compared to software and tech companies, where subscriptions play a smaller role. However, a high ratio of subscription-based revenues alone does not make a tech company great, as profitability also must be considered. Even a fully subscription-based business model would not be very attractive for shareholders if the company lost money on all of its subscriptions. C3.ai's revenue came in very close to the high end of the guidance range and above the guidance range midpoint. That's a good thing, as companies that underpromise and overdeliver are more reliable and make better investments than those that regularly underperform their guidance numbers. The company guides for revenues of $74 million at the midpoint of the guidance range for the current quarter. If the company's results come in at the upper end of the guidance range, as they did in the first quarter, C3.ai could grow its revenue to around $76 million for the quarter, which would represent a sequential growth rate of 5.6%. This is not a very impressive growth rate, but it is better than the 1.4% sequential growth rate that the company achieved in the first quarter. C3.ai Q1 earnings results. Bottom line, C3.ai is a company that has a lot of potential as it operates in the fast-growing and lucrative field of artificial intelligence. The company has some impressive customers and partners, and it is investing in its generative AI offerings, which could be a game changer for the industry. However, the company is also facing some challenges, such as its lack of profitability, high valuation, and fierce competition. The company's first quarter results were not very impressive, as the company posted a loss and a modest revenue growth rate. The company's guidance for the current quarter was also not very exciting, as it implies a slow sequential growth rate. I think that the company needs to show more evidence of its ability to grow its revenue faster and improve its margins before it can be considered a buy. Before we continue, comment below with your thoughts on C3.ai. Are you a buy, sell, or neutral? Last September 6, 2023, AI stock plunged by over 15% in early trading. The company's sales of $72.4 million for the quarter came in at the higher end of its guidance. Its loss per share also narrowed down to 9 cents from 12 cents the prior year's same quarter. Subscription revenue accounted for 85% of the total revenue. However, the company ended the quarter with a negative free cash flow of $8.9 million. For the second quarter, the company expects sales to come in between $72 million and $76.5 million. The company had to back off its goal of achieving profitability by April 2024 due to plans for more investments in generative AI. Analysts polled by FactSet expected July quarter sales of $71.6 million, an increase of 9.6% from a year ago. Analysts also saw a loss of 17 cents per share for the quarter. JP Morgan analyst Pinjalim Bora, who has a neutral rating on the stock, does not see top-line metrics materially inflecting higher at this point to justify the increased investment posture. AI stock has gained an impressive 180% so far this year amid a broader AI rally, but it has been weakening for the past several weeks. The company changed its pricing model from subscription to consumption-based pricing in December, bringing it in line with industry standards for software-as-a-service providers. Consumption pricing works like a utility bill. The higher the consumption, the pricier the service. This move could drive revenue growth, but not immediately. CEO Thomas Siebel indicated that the consumption pricing model will lower barriers to entry because companies do not have to be tied to long contracts. Siebel sees AI applications revenue hitting $600 billion, driving a fast-growing space. That is far less than Cathie Wood's prediction. The ARK Invest chief said in her firm's Big Ideas 2023 report that AI could add $200 trillion to the economy by 2030. Generative AI will increase efficiency for professionals. AI stock has a first-mover advantage, touting partnerships with Alphabet, Amazon, Microsoft, Accenture, Baker Hughes, and others. Generative AI helps computers apply machine learning and artificial intelligence to vast data sets, learn patterns, and generate content based on those patterns. Enterprise AI makes this content specific to business needs. AI stock skyrocketed in February when users successfully tapped OpenAI's ChatGPT artificial intelligence app to generate answers, texts, emails, and even books. The enterprise software stock popped on its first day of trading on December 9, 2020, leaping from an IPO price of 42 to finish at 92.49. The stock's current composite rating of 71 is less than ideal. The low 35 EPS rating reflects the company's many years of losses. However, the near-perfect 97 relative strength rating indicates the stock's superior performance compared with other stocks in the IBD database. With C3.ai stock still trending lower, the stock is not a buy at this time, so we remain neutral from our end. So, when considering investing in C3.ai or any stock, it's crucial to carefully evaluate the pros and cons. Remember that investing in stocks always carries risks. Thorough research, understanding the market dynamics, and weighing the potential gains against the challenges is essential. Stay informed, make informed decisions, and approach investing cautiously and diligently. Do you agree that C3.ai has the potential to change the AI industry? And what are your thoughts on its recent financials and stock performance? We want to know what you think. Share it with us in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, I highly recommend watching this fantastic video to learn more about a different company making waves in the tech industry. Just click the link below and immerse yourself in invaluable insights. Thank you for watching. Stay tuned for more exciting content in the future.